Good morning. Welcome to the show. Today we are going to talk about market width in options. So it's the bid ask spread that we all talk about so much. We're going to break down a few observations from the guys today on the Traders Workshop. Stay with us for the opening bell. Hola. Hello, guys.
Buenos dias.
Buenos dias. You know what I was
Alex,
thinking?
you're still wearing your Mardi Gras beads from.
I'm from New
How
Orleans.
many people gave you those?
Right. I'm from New Orleans, as you know, and this is a lifetime of collection. Yesterday was Mardi Gras, and I didn't go to bed because we partied all night. So
You mean 2 days ago, sort of?
yeah, right. Exactly. Good point. Right. Taping. I get it. Oh shit. Oh, another swear word. No, how are you guys? Good to see you. Hey, by the way, I was thinking when we come on together after the cold opening, I think we need a fade out of music somehow. It's just stark right away. It's just uncomfortable. You know what I mean?
It's like a second cold open.
It's a second cold open. So I feel a little awkward there. We're going to talk to Max about that one. A fade out of music. So anyway, neither here nor there. Okay, market widths. Let's get on it. Mark, this was kind of your idea, I think. Not kind of, but yes, your idea. You have an observation. First of all, let's explain, market width, what it means, why it's important, blah, blah, blah. So, and we'll have two different perspectives from a market maker side of the world versus a retail trader side of the world. I think we will. At least I will. So anyway, go ahead.
Yeah, so Jason and I have been going back and forth, excuse me, on this. And I think, you're right. Let's, first of all, definition terms. You can talk about widths a lot of different ways, like what width you're talking about. Are we talking about the zero DTEs, the near expirations, the in the monies, the out of monies? There are a lot of different ways to slice it. Are we talking about SPX? Are we talking about the top 250 names? Market widths vary significantly.
Mm-hmm.
But we can talk about them, first of all, even just talking about the difference between the bid and ask spread can be computed in a couple different ways. You can compute it just in pennies. You can compute it in implied vol terms.
Mm-hmm.
But then there's also the idea of effective widths. So the bid ask spread, the MBBO is the posted liquidity of where, bids and best bids and offers are for that security.
Yep.
But that's not always the retail trading experience. That's not always where people get filled on their complex orders, single legs, whatever.
Mm-hmm.
That most often there's quite a bit of price improvement. I think the average price improvement level that generally trades around is my handle is 30 to 50%.
Mm-hmm.
Sometimes it's even better, but you expect to get at least half of that bid ask spread difference between ask or bid, depending on which side you're going in the mid, you expect to get at least half of that back. And one of the things Jason was noticing is that effective spread has actually widened while I'm seeing the nominal spreads denominated in implied vol terms somewhat tightening. So we have a couple different things going on.
Yeah. So wait, when you saw, what does the effective spread mean again? Explain that again. I'm sorry, I'm going to miss that. What do you mean by that?
So I would simply define effective spread in qualitative terms as the level at which you get executed at. If they're inside, orders from auctions, price improvement mechanisms, that those will trade better, those will print better than the MBBO.
Okay, I got it. So, but that's not really, that really can't be mathematically computed. And the only reason I say that is because every strike's different. So it's going to be a random walk most of the time. Yes, there's price improvement. I guess you could look at all the trades and say, on average, here's the percent increase. Or improvement, I should say. So
you're handing me layups left and right. I mean, that's exactly what the retail brokers will do to monitor their market making partners and the execution quality that they deliver.
Right.
So they snapshot the bid ask spread right before the trade comes in and then compare the number of pennies improved that is relative to the lit markets at the time.
Yeah.
And then they add up all those pennies and divide them by all the available pennies, and that's
Sure.
your EQ percentage.
Okay, I got you. I understand. Perfect. I would say too that for the retail folks, they tend to talk about the band of at the money. What I mean by band is, you pick your delta poison going down for the put, up for the call, and that band is where, most of the retail players live, I'd say. I've had a few folks kind of push to me that I'm trading deep in the money call spreads and deep in the money put spreads. Clearly, those markets are going to be wider, I think, generally across the board than the ones at the money, right? That's where liquidity is at the money, not in deep, 70, 80, 90 delta options. Fair enough?
Can we cue the screen share?
Let's cue.
Yeah.
I got an idea. Let's cue the screen share.
Well, yeah, let's do that. But before that, I kind of wanted to talk a little bit from a retail standpoint, like why is this significant? Those bid-ask spreads are kind of a signal of liquidity. I mean, if dealers are kind of pushed one side or the other, they need to make that up. That is their bread and butter edge, is selling at the bid, buying at the ask. So, or
Other way around.
Yeah. Other way around.
Not
That's
going
what I
to
do
be
now.
very long like that.
By the way, I do that now in the retail world. I sell the bid and buy the ask. Totally foreign to me.
So anyway, their bread and butter edge is buying at the bid, selling at the ask.
Right.
And so when those spreads widen, what that is saying is that there may be lower liquidity. Dealers are trying to capture more edge in order to make up for maybe trading too far to one side of the market. So, and liquidity is one of those things where it kind of sneaks through the whole market. I mean, if you have liquidity problems in options and market makers, then, probably bond traders are also having liquidity problems. They're trying to make up for it in options, and, it kind of snakes through the whole market. So It is a good signal for, even if you're not trading options, for liquidity. If markets are tight, that means you're probably getting really good two-way action, and liquidity is plentiful, and, people are getting the getting the assets they need.
Sure.
The way I like to think about the bid-ask spread, and a wiser senior trader taught me this when I was just a young buck, was that it's a confidence interval, that it's a confidence interval around a theoretical value. And if you are very confident in that price of volatility, because you have tons of other listed strikes that are trading actively, because two-way order flows banging your bid and lifting your offer, like if there's tons of offsetting risk that's like flying around, like you can be very confident in that price of volatility. As you start to move down the tiers and you start looking at Canadian uranium miners and FDA dependent biotechs, like that price of vol is very uncertain. And so you start to see those wider spreads. But also, like Jason's saying, like it varies over time, of course. And like if we're at a vol level that the market feels very confident in, that's aggressively traded and valued, priced, then we're going to see tighter bid-ask spreads. When the market's less confident about what 30-day vol looks like or 90-day vol looks like, you start to add a little bit more fat, because that input's more likely to move around and it's going to cost more to hedge it. And you don't want to offload like your whole risk limit like at this price or whatnot.
So here's a question, right? It sounds like it's a little bit of a chicken and egg sort of thing, right? So if we have massive amounts of activity and volume in a particular name, then as you just said, the confidence interval is going to be greater because more things are trading, right? However, that might not always be true. Let's take the case of pre-earnings, right? So even in a stock like Tesla, perhaps, and I'm not saying this is actually true, I don't know the answer to this, that prior to a news event or something that's out there, even though there's tons of liquidity and tons of trading, the confidence interval still may widen out. Fair enough? Because of, uncertainty.
Best names to trade in the world.
Right.
High volume, no confidence.
Exactly. That was going to be my next point. So from the market maker side of things, Mark and I, our firms back in the day, I like to trade, intermediate confidence interval sort of things. What I mean by that is, not exactly the spiders of the world where there's so much activity there, pick 'em markets penny wide. But something like in the C class or even D class for that matter, which is less liquidity down the line. So I'm willing to take a little bit of risk on my bid ask, but I'm also going to widen that out. And that's where Jason alluded to is our market maker edge, that bid ask spread. Yeah. So,
yeah. And sometimes there's, a lot of people ask me too, I don't want to open up a can of worms, but a lot of people ask me, how come SPX has so much liquidity and so much volume? RUT has so much liquidity and so much volume, and nobody trades NDX. And why are those spreads so wide? And that's kind of a market distortion. Is that right, Mark?
I would agree. Like, I don't have a brilliant answer for why NDX.
Oh, I know the answer.
You just editing.
So
what did you say? You just learned the answer just sitting here like that?
No, I knew the answer. I was just giving Mark a cookie.
Oh, you were giving Mark a bunny. I got it. Okay.
Yeah.
Mark, I think it's as simple as liquidity begets liquidity. If no one trades, then no one goes there.
Well, it's because Susquehanna has a monopoly on market making those options.
I don't know about
they
that.
have a monopoly on market making.
That's what I read. That failing.
They're the specialists in
NDX.
And NDX. They have been for a long time, even when I was.
And Susquehanna is the only market maker in those options, so nobody trades them.
Well, think of it this way. Think about it from Susquehanna's viewpoint. Let's argue this for one quick second while we're on it.
Mm-hmm.
I know those guys pretty well, and my feeling is that while they like those super wide markets, they'd rather have tighter markets and more activity than not. So it behooves them to tighten those up and trade them. So there's a reason why they're staying out of the way. And I love the confidence interval argument here. Maybe they've tried to tighten those babies up and still nothing happens. I don't know. Mark, you have any thoughts on the NDX part of it?
I still kind of go back to my liquidity begets liquidity, that it's not worth their time to trade something like that. Like, that's gonna, like, to get that flywheel of liquidity going, it's like order flow is going elsewhere. They'd rather trade where the order flow is going than try to like bootstrap a product and, put themselves in front of the risk of doing that, even though like Qs are probably better priced than NDX. You sort of run the reverse that you do in SPY.
Yeah. I mean, I go to my microeconomic background and I see, if there is a monopoly, it will skew the demand, it'll skew the supply curve to a point where it is the most optimum demand supply area as opposed to the most beneficial for the customers.
Well, but anyone can trade them. Just because they're the specialist doesn't make them necessarily a monopolist.
Yeah.
My understanding, I thought I think I read that somewhere. Somebody told, I read that somewhere that Susquehanna is the only market maker for NDX.
Well, I believe that. That's probably true. They're the only market maker, but it doesn't. The market's open to everyone. So,
any market maker can pick it up.
Yeah, any market maker can pick it up. I looked at trading NDX as well because I like the higher priced underlines. Like, I love SPX because of the size of it, which is contrary to probably what most people think. I'd rather trade.
I mean, you're Lex after all. You've got to go where the size is.
You got to go where the size is, man. So I like that part of NDX, right? A lot. And it baffled me because, Mark, if you remember back in the day when we were on the floor, at least I was way back when, that was a busy pit, NDX. It was very active. I believe Susquehanna was the DPM. And it was a big pit because my former broker moved from my old pit once it became a DPM into the NDX and certainly made a very good living there. So I looked at it.
Happened with OEX too, right? Like,
That's
that
right.
was a vibrant pit, and all that flow is really just consolidated in SPX, I think.
Yeah, I think that's right. Okay, so let's get back to the bid-ask phenomenon here that we're noticing. So we talked about confidence interval. What was the other one? Equivalent EQ. What was that one again? Equivalent something. Quality.
EQ stands for execution quality.
Execution quality. Okay, and that's and you said that's a number that maybe someone like SIBO is following. They can compute that. Is that right?
Well, I don't know that SIBO necessarily, like, SIBO is very aware of it because, like, that's how order flow is going to trade on their exchange.
Yep.
But it's more the relationship between Citadel and Schwab or Wolverine and E-Trade. that E-Trade or now Morgan Stanley and Schwab are sitting at their computers in Arizona and New York and looking at all the market data and saying, okay, Citadel, we sent you 25 million orders like last month, and the average EQ on these names was 32. The average EQ on these names was 35. Citadel did 35. Hey, Wolverine, how come you guys are doing 37 on the same like thing of our or roundabout of our flow?
Okay.
Like,
yeah. So this is an important point for the retail person, right? And I want to make this point. There's a perception among retail people that the market making community is dastardly and is taking advantage and, blah, blah, blah. We've heard all those things before. But these sort of metrics are in place for market improvement and market quality, which helps the retail person. And I keep telling the retail folks that you don't understand. Retail people want you to trade on their bid and offer. Not only that, they're even improving it a little bit, and they have your brokerage on your side to point out when this EQ level isn't exactly up to snuff relative to the competitors.
So I'll take that 2 steps further because I couldn't agree more. And like I think this is like one of the most important points that retail traders need to realize, or that like it's so easily distorted, this view that like dealers are doing this or that, or like, and I actually wrote a blog about it last week. I put the link in the studio chat. Okay. But there's not only are the market makers competing against each other to get a slice of that flow, and like the brokers are monitoring their performance via these EQ stats on like a monthly basis. They're looking at that. The way the microstructure of how that order actually gets traded in the price improvement mechanism means that you can't even have a cabal of people that are like all the ones that are on the wheel. So you can't get Citadel, Wolverine, like Susquehanna, Morgan Stanley sitting in a room and going, you know what, guys, like let's only deliver 45 EQ. Because those auctions are public, anyone with a feed, now granted, that's like a technical burden, like that's not exactly simple to like consume that, like retail can't do that. But like anyone that's a prop trader can get in and price improve these and best out, whoever Citadel that took down that order and is looking to like juice a little extra EQ on something. So even if Citadel's underperformed their numbers or delivered better EQ and they want to get lazy and collect more edge, someone else is going to come in and snipe that order from them. So there's both like at trade time and ex post forces that are working on execution quality.
And that probably happens, that concept happens much more in the very liquid names than in the NDX, for instance, where there's one market making person. He has very little incentive for a better EQ value. So that's why I tell the retail folks that, they always ask me, well, I want to trade the stock. Look, I look at it and the at the money near term is, $2 at 275. I go, really? This is what you want to trade? You're taking such a haircut to get in this position and get out of it. I get it. You love the name of the stock, but why? So I have this debate a lot with the folks.
And I think it's interesting to realize, like, knowing that might be the dynamic, like that helps retail. Like, how does this improve my trading? Whatever. Like, think about when you cancel, replace. Think about like how your order might look. Like all those different things. Like, might send it down a different wheel. Like maybe your broker has like, for example, I know certain brokers get great individual leg improvements, but they have bad spread relationships. So like if that's the case, maybe you need to break up your spreads to like get them executed. I know there's leg risk and all that, but like the sort of business behind how that order flow gets sold does trickle through, sometimes randomly, but sometimes, deterministically to the end trader.
Right. Okay. Go ahead, Jason. Sorry.
No, I was just about to say, it's just what people get mad about, and it's kind of something that goes throughout the whole financial industry is how are you, there was a book called Where Are All the Customers' Yachts, where it was about, how all the financial advisors are driving around in their, Lamborghinis and their yachts, and, their customers don't have those yachts. Ken Griffin is sitting there buying the, $40 million compound.
40 million
house, and he's a market maker.
Guest house.
Add another zero, baby. Jesus,
but
40 million. Yeah, that's the guest house. That's right.
That's where I think people get these, impressions from. But I don't understand that because, and maybe it's because they don't see the benefit that market makers do. Because I agree with you both. That market makers, these high frequency traders, and Flash Boys and Mike, they were actually helping us, even the SEC. I mean, if they get their way and they start, making life harder on market makers, it's going to be harder on the retail trader.
Way harder. They have no idea.
Yeah. So
that's a whole nother show. My complaints about regulations, but
yeah, but I mean, nobody complains about Elon Musk being the richest guy on earth because they see a Tesla, they see the thing that he makes,
right? And you can buy it,
right? And it's something tangible. So I think that's really, where what's the guy's name from who does the Louis Vuitton,
Bertrand,
those are luxury bags and luxury, whatever. They see something, they can buy it, and because they can't see what the market makers are doing, they must be stealing.
Yep, exactly right. Okay.
Do you want to pull up a screen share? I want to make two points with.
Let's take a look at this. And I have some more comments and questions for you guys about some other things here relative to markets. Go ahead. What do you got here?
So in terms of like both improving spreads and that confidence interval point, this is the difference between, in red, I have all sub 30 expirations, excluding 0 DTEs, and in blue is 0 DTEs.
Okay.
And so this goes back basically to when like true 0 DTEs, daily expirations were introduced.
Yep.
And when they first get introduced, like you see the average spread, there's a lot of variance in this. That's the first notable thing is like the end of day, like, variance is quite a bit in the 0 DTEs.
Sure.
But then like broadly this trend line, when these things first get introduced, dealers are like, yes, I know we've always traded expiration and whatnot, but like being forced to do that and get so many more reps, see what the order flow looks like in here, see the development of all these strategies that are now solely 0, like that's a different texture of flow that's coming.
Right.
But as they've adapted to that, they've been consistently delivering tighter and tighter 0 DTE spreads over time. So like as people get more confident with the types of counterparties, the dynamics of order flow, not necessarily like the expiration Greeks of it, I don't think. Like I said, like they've been dealing with expiration forever, but like I think there are unique new textures to this order flow. But they've been delivering tighter and tighter spreads on that. And I think that's a function of increased confidence and just this is a long-term trend too, right? Like if we pulled all spreads over the last 20 years, right? I mean, like stuff was in nickels 10 years ago, quarters 15 years ago.
Right. In eighths and sixteenths 20 years ago.
Yeah.
But maybe a little more.
Mark, what's the y-axis there?
The y-axis is implied vol percentage.
Okay. Yeah, it's not like so I was just figuring you should tell me.
So wait, implied vol, the difference
over here.
Yeah, so the difference between bid ask implied vol?
Correct. So 15 vol bid at 17 vol offer is 2%.
Gotcha. Okay, makes sense.
I like that measurement.
Yep, that's good. Yeah, so
normalized across prices, unit, stocks, everything.
Right. Okay. Interesting. Cool.
And then the point about at the money, out of the money, like this is the nominal difference between those spreads, right? Like this is actually just SPX here. Or no, sorry, this is the top 250 names. But yeah, your at the monies are like 2% wide, whereas like you can get 20% wide once you start going out of the money. And I even threw out the 1 and 2 delta options here. So
I was going to ask that. The 5 cent at 10 cent is a really high percentage width, right? As opposed to a $2 option.
Correct. So there's definitely going to be some of that because there are 5 and 10 cent options in like Snap or whatever that are out of the money.
Right.
But I did throw out, I forget what the exact delta threshold was, like whether it was 2 or 3 or something like that.
Gotcha. Okay. Yeah. Interesting.
It's so late, or I guess like mid to late January. I started talking on Twitter about, kind of a little bit widening spreads, which we use kind of like a similar to EQ kind of thing. But you could see here in Mark's data, the out of the money spreads, you could see kind of lifted off and then stayed pretty consistent in like a kind of a higher level. Pretty much once we hit 5,000 or I guess approached 4,900 and then 5,000, we saw kind of a bump ourselves. So,
yeah. Okay. Cool. This is interesting. Okay. So question, we can go back here. I had the question in Mexico at a summit about level 2 quotes. Okay. So it's beyond the NBBO. And the question was centered on if you had a big enough order out there beyond the NBBO, do market makers lean on that size and put markets in front of that size order? Mark, I'll go to you first because you have experience probably with this in the market making world. I had an answer. I'm going to tell you what my answer is in a second, but go ahead. Any thoughts? Or Jason, if you want to jump in too.
I think there are reasons why you would, for sure. Like, I think sophisticated market makers are definitely consuming level 2 data. I don't think it's probably as like nefarious as like it sounds when you say it in words. I think it's just like understanding a heat map of where liquidity is their job.
Yep.
As far as like what it applies to, you didn't directly ask this, but like, should retail be concerned about that? I would say the answer is like, probably not.
Well,
like it's
yeah. And that's a good point, because my answer to them was this. I said, listen, my guess, no matter how much money you think you have, you are probably not influencing a very, very liquid market with your size being posted in the marketplace. When you get to, I don't even know if 1,000 lot even matters anymore, but when you get to 10,000, maybe that moves the needle, that it's sitting out there and maybe they're playing a game. And I said, look, it's like Texas Hold'em. You get 2 cards pushed down to you, right, that no one else can see. If you're putting your 10,000 lot out there, it's sort of like flipping 1 card up for everyone to see where you are in a way, right? So will the market maker take advantage of that? Listen, they're card players. They're statisticians. Maybe they will. Don't do it if you're that big.
And maybe it doesn't matter to them, right? Maybe they see that 10,000, they're like, it doesn't matter, sold. Like, like
could be. I mean, I know in our trading days, it took a lot less than that. When we saw that on the book, the 1,000 lot, you're trading everything in front of it. And then, okay, if I need to bail, I'm going to take the book and lose my penny. Right.
But like, you also had that dynamic where like, I'd say more often this is not necessarily like at a level 2, like behind a bidder offer, but like more likely when you have like an order that's like clearly trying to chip away at an offer.
Yeah.
And like, you can see them posting on this exchange or posting on that exchange. And like, the game of like is more trying to like wait until that hits a level that's good, but also wait until it could get better, but you want that order. And so like, in some ways, like if it was those big orders that I think market makers are more concerned about when they're lit and getting, kind of displayed to everyone.
Sure. Okay. All right. We should probably run here as we're getting long. What do you think are the key takeaways here for the retail person? What should someone in the retail world take away from this conversation? Any thoughts there? Don't all jump at once.
I mean, I would say that the first thing is that bid-ask spreads are important to determine. I mean, it's kind of both the same thing. It's, 2 sides of the same coin, either market maker confidence in the current fair value that, like whatever that midpoint is, the market makers are very confident that is that is going to be within the realm of possibility. In the shorter term, those spreads will be narrow. And if they're not very confident, or you could say liquidity is getting short, or for any number of reasons, those spreads will widen because they need to capture more edge in order to take advantage, or in order to allow you to take advantage of options to use that and keep their profits.
Sure. Okay. Good. Mark, any last parting thoughts here?
I think on an order by order, like execution basis, keeping the 30 to 50% EQ level in mind is a really useful like rubric for where to expect price improvement. So obviously that arithmetic breaks down. If you're looking at a penny wide and SPY, just take the offer and move on and like enjoy your, 500 level. But like if you're looking at something that starts to get to be like a nickel, a dime, a quarter wide, nickels across a condor like ends up being, 20 cents wide. So going for that like 30 to 50% level. So midpoint, you're buying ask minus midpoint, split the difference between those two. Like that's roughly where I think, a good expectation for, fills is.
Perfect. Love it. That's why I trade the product I trade.
You just move on with your life. It's beautiful.
Well, it's also expires in 6.5 hours every day. I have like a short attention span. I can't take it.
Are you rooting for hourlies? Are you one of those guys?
That's interesting because a lot of the things that these retail folks do in 0 DTE occurs in the last hour of the day. So interesting, but that's probably not out of the realm of possibility in the world of options trading. Hourlies. Can you believe it? We're starting to, it's almost like
Start with a nooner, maybe.
a nooner. Go with a nooner.
I'd love to trade nooners.
Oh.
You have your expiration by noon, then you go to lunch. It's
That's
fantastic.
right. How good is that? Well, let's make it 10 so you can warm up at the golf course a little bit, take a few swings.
Yeah, exactly. I didn't even think about getting 9 in. Oh, yeah. We'll just do the first 30 minutes of the day. It's all we need.
Perfect. That's good. I love it. That's coming. Stay tuned. All right, guys. Good to see you. Great chat today. I loved it. You guys have a good weekend, and we'll see you next time on the Traders Workshop. Have a good weekend, guys.
Happy trading.
Happy trading.